Joshi. He's joining us this morning from MarketSmith India. Mayuresh, there's so much to talk about this morning, and thanks so much for joining in. Let's first talk about steel companies, right? Because we were anticipating that this would happen, and we just spoke to somebody from HDFC Securities, and what he was saying is that he would be advising his clients to go ahead and buy even if there's a gap up today, because he feels that the valuations are not challenging, not egregious at this point. Do you concur?
Morning, Alex. No, I think it is going to be sentimentally positive as well as EBITDA positive as well. So to that extent, I think steel companies, specifically, I think Steel Authority of India and JSW Steel might actually be the beneficiaries of this safeguard duty that's probably come through. But outside the duty, I think the market will then look out for the operating performance as well. And if you probably look at how the macro dynamics are setting up for the sector as a whole, right? If you probably look at the blended cost, which is the first and the most important thing for steel companies, the blended coking coal cost from Q2 to Q3, which was at 2,600, has come down to around 19,600. And in fact, it might come down 1,000 rupees more. So it might actually go below 19,000 as far as coking coal costs are concerned. The Australian hard coking coal, somewhere around $185 per ton. At the same time, if you look at the pricing of the end products, longs are somewhere around 53,500, 54,000 per ton. Flats have come down in the last quarter by 2,000 rupees per ton. So to that extent, the 47,000 mark per ton for flats might actually go up with increasing demand coming through and might actually hit that 49 or 50,000 mark as we speak. So the combination in terms of safeguard duties, which probably means that companies might be able to take price hikes, input cost expected to stay lower and going lower as well, and end product prices expected to improve, will have a significant take in terms of the EBITDA for most companies, particularly SAIL and JSW, in particular for SAIL in general. Also, I think the cess, which is probably some concern that all these steel companies have, why SAIL would probably also stand out is because they have no exposure to Karnataka. The mines that they've got in Jharkhand, Odisha, and Chhattisgarh, Jharkhand has already levied 100 rupees cess. The other two states might also do that. But with the hikes, I think a pass-through is possible, which protects EBITDA margins and that for bottom line growth. So yeah, I think it is beneficial for steel companies, SAIL in particular, followed by JSW.
Okay, so steel companies in focus this morning. Mayuresh, very good morning. Just wondering if you see the kind of boost we saw for banking and the whole BFSI space to continue. I mean, truly the star of what we saw yesterday was the Bank Nifty, and even as we're set for a positive start as per the implied, maybe not the roaring start that we saw yesterday. Do you expect the Bank Nifty push to continue? And if yes, are you very excited about ICICI Bank even at these levels and after the recovery you've seen?
Morning, Tamanna. No, I think as a space, I think let's go back 2-3 quarters, right? I think the entire problem area was probably deposit mobilization and obviously the CASA deterioration that you've probably seen. But with the data points that are coming through, specifically over the last 2 to 3 months, you've seen deposit growth actually go head on head with credit growth. In fact, 2 months out of 3, I think it has actually outpaced credit growth to a large extent. And therefore, I think the kind of deterioration that we've probably seen, both in terms of deposit mobilization and the CASA ratios as well, I think that should probably plateau out and show significant signs of improvement. As that happens, I think, and once the normalization starts taking place, specifically in terms of advances growth, what RBI has probably done in terms of unsecured advances, personal loans as an example, I think it's a prime example in terms of the risk-weighted assets onto their balance sheet as well. With the provisioning that has probably happened in these areas, along with strong credit underwriting, my own sense is that credit deposit ratios should improve for the better. Cost to income ratios have started going down. The expectations in terms of asset quality deterioration is probably well laid out for the banking industry as a whole. And that should probably continue. And therefore, I think large leadership stocks, as you asked me, ICICI Bank, Kotak Mahindra Bank as an example, well, capital adequacy, specifically tier 1 ratios remain extremely strong, are well poised to probably ensure that the growth dynamics for the sector run through their individual balance sheets as well. And as far as return ratios are concerned, as far as the NIMs are concerned, at some point of time in the second half, as the rate cycle started going lower, I think the incremental positive elements in terms of both ROEs and ROAs will probably get reflected. So yeah, absolutely concur. I think remain constructive on ICICI Bank and Kotak Mahindra Bank as large leadership stocks to deliver the assessments.
Okay, so positive on banks and specifically those two that he just mentioned.
The other thing is, yesterday was a day of a lot of fallen angels really zooming up in trade, right? If you saw the breadth, want to be very constructive on the small caps or the broader end of the spectrum, but we saw large caps like Zomato moving like mid caps. Wonder if and today there is a note from HSBC which says that the GMV is not too bad, even though it's come off a little bit from the highs. Any thoughts on Zomato, Swiggy, either of these two?
Morning, Neeraj. No, again, I think broad-based move yesterday for the whole markets, and therefore I think within the broader markets, our take is have to be a little bit selective. When it specifically comes to players like a Zomato or a Swiggy, I think the kind of investments that Zomato is expected to make for this calendar year in particular, for improving or increasing its dark stores by almost double the count, it's almost to 2,000 odd. I think a large part of that capex and free cash flows that are probably expected to come through specifically from the food delivery business might probably get deployed, as well as the cash that they probably got on the balance sheet. So they've got almost 20,000 crores in terms of cash, which probably needs to get deployed to a large extent. And therefore, I think the preemptive nature in terms of the aggressive store opening will probably mean that numbers which were expected to improve specifically for the quick com business, as an example, or even the hyperpure business for Zomato, I think that might just get delayed by a lag. And therefore, I think the analysts which had pegged in a significant amount of recovery by 26 end, that probably gets deferred. I think the market gestating that entirely as far as financials are concerned, both for Zomato as well as Swiggy, which is also sitting on a 10,000 crore cash kitty, which will get deployed in terms of the capex that they probably got in terms of dark store expansion as well. And therefore, I think the markets will take in its stride that the next 3 quarters numbers are going to be soft as far as Zomato and Swiggy are concerned. And therefore, I think there might be a phase, in my opinion, where the stocks might actually go into a time consolidation. You might see these sporadic bouts of a price action coming through with the kind of oversold territories that they were into, the heavy selling that we saw. The respite has probably come through, but whether there is a re-rating around the corner immediately as we speak, I think the markets will take their time, and therefore some element of time consolidation for both these stocks.